everyone was really looking to the US. And they were looking to the US because most stablecoins in existence reference the US dollar. Why do they reference the US dollar? Because the US dollar is king, right? We are the world's reserve currency. So basically all stablecoins in existence, almost all of them, are dollar referenced. So there was a lot of anticipation from the rest of the world to see the US do something.
Welcome in, everybody. You're listening to Wrestling Payments, a podcast where we help payment professionals contend with the challenges of modernizing their payments operations and identifying ways to build for the future. If you're interested in payments innovation and modernization, you're in the right place. Now, let's get into it.
Hey, welcome to Wrestling Payments. Today we have a very special episode with two of my new friends, one an old friend and one a new friend from ICBA, talking about a really interesting topic in the world of banking.
As title would suggest, I pretty much focus all of my time exclusively on digital assets policy issues, but I also have cross-border payments under my wheelhouse as well.
And Mickey?
Hi, I'm Mickey Marshall. I'm a Vice President and Regulatory Counsel at the Independent Community Bankers of America. Work on payments issues, novel charters, and cryptocurrency along with Brian. Happy to be here for this conversation.
Excellent. Why don't you, if one of you want to start or both of you want to start, it's up to you. Who is the ICBA?
Sure. So the ICBA, we are an association of community banks. So we traditionally represent the smaller side of the banking sector. You know, these are local banks in local communities. They do a lot of small business lending, small farm lending. They tend to have, smaller branch footprints than your typical regional or national banks do. And our job is basically to make sure that they're not forgotten about in Washington and that their voice is represented in the legislative process and the rulemaking process. So when you have regulators coming out with complex new rules, we want them to account for the fact that there are still small institutions in this country that are playing an important role in their communities, and they need, their own set of compliance requirements because what works for the very large banks doesn't always work for them. And, that's what it's our job to convince Congress and the regulators.
And how many members do you have about?
So we represent a pretty good portion of the banking industry. Most banks are small. So we represent several thousand community banks nationwide, which again is going to be a majority of the community banks that are out there in the country.
Excellent. So we're here to talk a little bit about a really interesting topic, things that are going on. I want to do some background first. So what we're talking today about is the intersection of fintech and banking. And I pose it that way because what we're seeing is it's not necessarily an intersection. Sometimes the fintechs are maybe, I guess, in which I could agree with, the fintechs are taking a bigger and bigger role in banking, a role that there's just a different set of rules for fintechs versus financial institutions. But do you guys have any examples of, before we get into the main event, the places where fintechs have taken charge? And I can give you a quick example of what I'm saying. I was at the clearinghouse event a couple of weeks ago, and they made an announcement and it wasn't an announcement, it's just a fact. The fact that the banks used to handle all the lending, all the mortgage lending. They were the top 8 lenders in the country. And now only 2 of the top 8 lenders are financial institutions, which is not an intersection. It's more of a takeover. Do you guys have any examples of other things like that?
Yeah, I think you've seen it in a lot of sectors, and I'll start even just talking about the home mortgage segment. I think a big part of that theme there is that it's more attractive in some cases to lend from a non-bank perspective because you don't have the same regulatory and supervisory requirements that a regulated bank does. So for example, in the home mortgage space, if you are a non-bank, you're not subject to the Community Reinvestment Act, which all banks are. And so that right there is an immediate competitive advantage you have because it's one less level of regulatory compliance. And so, yeah, I mean, we've seen this in mortgage lending. You've seen it a lot in the payment space. You've had sort of non-banks there, PayPal, Square, different types of wallets that allow customers to process payments. That used to be a solely bank function, but now it goes to a less regulated space. And I'm sure there's other examples we could think of, but even, consumer lending also has gone into a lot of, non-banks. You've seen, with some of these different charter types, like the industrial loan company charter, you've seen large automakers. Now, that is a bank charter, but it has some special carve-outs, being exempt from the Bank Holding Company Act, for example, that allows, non-bank firms or non-financial firms to own a bank charter and engage in lending. So I think, around the edges, you've definitely seen more competition enter that is from non-traditional entities and non-bank entities.
No, I agree. I agree totally with that. Let's slide over a little bit to recent developments. So over the summer, we saw the passage of the Stable Act. Stable Act?
Genius Act.
Brian, you know a lot about that. Do you want to chat a little bit about that? Genius. That's right. Sorry.
Yeah, so the Genius Act was passed in July of this year. This was a landmark piece of legislation that created a special subset of stablecoins called payment stablecoins. So with this, we now have at least a rough framework for how payment stablecoins should be regulated within the United States. I say rough because, of course, the passage of Genius, that just set off what's going to be a race to the finish line. The regulatory agencies have a number of rulemakings that they need to initiate and complete ahead of the official date of enactment, which is going to be, or rather, the effective date of the act, which is January 18th, 2027, or 120 days post final rules. So basically what that all means is next year in particular, it's going to be a very, very, very busy time in terms of the agencies putting out requests for comment, gathering public feedback, digesting that, and then creating the final regulatory framework.
So I recently had a couple of folks talking about stablecoin and how exciting it is, but from the regulatory perspective, as I understand it, it's going to be a lot of state regulators if they've decided to get into that area. Otherwise, it's going to default to the Federal Reserve. But it really is in the middle of rulemaking right now. So regulators are trying to figure out where are they? What are the regulations going to be? I think we all know the basics of it, as far as they're going to be required to, anyone who issues it is going to be required to have dollar for dollar liquid availability, typically in a treasury, and they're going to be audited on a regular basis, examined. Some of the bigger folks, so it's not like everyone's brand new, right? Some of the bigger folks are going to be regulated by the Fed. Some of them are going to be regulated by states. And I know, just anecdotally, we had a conference just recently, and there was a Fed speaker on stablecoin. He could not finish his presentation because all the folks attending the event peppered him with questions. What's this? How's this going to work? Any cleanup there on what I said? Is there anything that I'd said wrong or could be better explained?
So, yes, it's right. The rulemaking just started. It started with requests for comment from the Treasury Department that came out, I believe, middle of August, having to do with using innovative technologies to detect illicit finance and digital assets. That comment period closed on October 17th. But then there was, at the same time, another one, much more substantial one. It was a notice of proposed rulemaking that came from Treasury that basically touched on every single important element within the Genius Act. So this is soliciting public comments on how the federal government should approach what should determine parity in terms of the federal and state regulatory frameworks. How should they think about stablecoin issuers posing a material risk to the U.S. financial system? And one question is of particular interest, let's say community bankers. Treasury posed questions about how they should define key words in the interest prohibition that was established with the Genius Act. So payment stablecoin issuers, I mean, we got really stressed that point, the issuers, are prohibited from paying interest or yield solely in connection with holding a payment stablecoin. That does not extend to intermediaries like crypto exchanges. And crypto exchanges, of course, today, they're actually doing that. They're offering what some of them term rewards, which is basically like interest or yield for depositing your stablecoins on their platform. So there is a lot of really critical rulemaking that bankers need to pay attention to in the coming months.
I have nothing else except the main event. So let's talk a little bit about this. I know for Niche, when we respond to requests for comments or any sort of regulatory rulemaking, we're very demure and we're very, we don't want to rock any boats, even though we may want to rock a boat. And not saying anyone's rocking boats, but let's talk about the situation where a non-financial institution is applying for a limited bank charter from the OCC?
Sure. So yeah, this is a trend we've been seeing recently in this space. So the OCC has a charter type called the National Trust Bank Charter. Traditionally, this was a charter limited to trust departments, right? It was for banks that provided custodial services, fiduciary services, asset management, that sort of thing. It didn't really compete with traditional commercial banks because it's just a different business. If you're managing trusts and estates, that's different than the business of, taking deposits and making loans, commercial banking. But this is changing now. So there was an OCC interpretive letter, 1176, and that expanded the potential powers for these national trust banks to certain non-fiduciary activities, including non-fiduciary custody. This was a letter that was done without any formal rulemaking, without a change in statute, but like any loophole, it swallows the whole rule. And that's what we're seeing here with some of these cryptocurrency companies. So you've had a number of applications from crypto companies. You've had some prominent names in the space like Coinbase, Circle, Crypto.com. Stripe has applied for one of these charters. There's other applicants as well, Sony, Fidelity National Trust. All of these are cryptocurrency or payments-focused companies. And what they're proposing to use this charter for is basically to facilitate the issuance of a stablecoin. In some cases, the national trust that they're proposing to create would be the issuer of the stablecoin itself. In other cases, that's less clear. But in all cases, they would use this charter to manage the reserves of the stablecoin. And so again, what that means basically is we talked about how stablecoins are backed up by, either cash or by, treasury securities or other, very liquid assets. And that's what these companies would do, is they would use these non-fiduciary custody powers to manage those reserves to facilitate a stablecoin being issued. Our concern is that to a customer, that starts to look like a deposit-like product, because some of the applications, for example, contemplate, could we use this to apply for a master account? Could we use this to allow customers to access the funds in their stablecoin wallet via a debit card? So to a customer, you're getting a product where you can now easily send this to another third party. You can potentially access it with a debit card. That looks like, to a customer, it looks like a deposit product. And now couple that with the fact that they see this is an OCC charter. It's a the national bank regulator. It says, this is a national trust bank. I must have the same protections I do at a traditional bank. And I think our point of view is that's just not the case. So the balances in these wallets for these stable coins would not be protected by FDIC insurance. And then the other, I think, salient difference is the National Trust Bank charter, or the National Trust Bank, is exempt from the definition of a bank in the Bank Holding Company Act. And so the practical consequence there is, for a bank holding company, the parent of one of these trusts, or the parent of a bank rather, you would have Federal Reserve supervision at the holding company level. And so that would be the Federal Reserve making sure that the parent company is engaging only in permissible financial activities and, has the financial resources to act as a source of strength if its depository institution subsidiary becomes stressed. With the National Trust Bank charter, because of that Bank Holding Company Act exemption, you don't have Federal Reserve supervision. And so the parent companies of these national trust banks are not going to be supervised at that, consolidated holding company level. We don't know that they're, well situated to serve as a backstop if the National Trust Bank becomes stressed. And then number two, they're not constrained by the limitations on only engaging in financial activities like a bank holding company would be. And so this opens the door to a wide array of commercial firms, technology firms, retailers even could potentially look at this charter because they're not limited to those activities that are financial in nature. So again, when you talk about non-bank competition in the banking industry, we see this charter as a way to get a lot of the, the powers of a bank to take deposits, but without incurring any of the same supervision, without having Community Reinvestment Act requirements. And, if this starts to drain deposits out of the banking system, into these stablecoin wallets at these national trust banks, we think that's going to have a harmful impact on the communities our members serve. There was a Treasury report recently that estimated that up to $6.6 trillion of bank deposits could flow into stablecoins. I don't know that $6.6 trillion is going to be the number, but if it is in the trillions, that's a substantial amount of deposits that now aren't going to be recycled in those communities in the form of small business loans, farm loans, home mortgages. They're just going to go sit in Treasury securities in these stablecoin wallets, and they're not going to have that same positive economic impact they would if they were deposits at a community bank being lent. So I think that's really our concern here from these institutions is, that they're going to really drain a lot of deposits out of communities and not really contribute a whole lot back.
And if I could just add to that, it doesn't even need to be trillions for banks to potentially see an effect, right? Mickey referenced that report that came from the Treasury Department earlier this year. There's a more recent one from the Kansas City Fed, I believe it came out in August, that just looked at a modest increase. As it is today, there's approximately 300 billion in stablecoins. So the Kansas City Fed looked at what happens if they just grow to 900 billion, right? So far less than some of the higher estimates that we're seeing floated. Just going from 300 to 900 billion, right? If that 600 billion increase comes from commercial bank deposits, that could lead to a $325 billion reduction in lending capacity.
Does anyone want to take a shot at explaining why that is? I think my audience sort of knows that, but when you talk the difference between a bank deposit and a stablecoin that must be backed up by a treasury, it's the ability, and I'll take a shot. I kept talking. It's the ability for an institution, a community institution, to take in those funds and lend them to other people in the community. It's like a wonderful life. He said when they came to take all the money, well, your money isn't here. It's in his house and in that house. That is cut off once it becomes a stable coin, those funds, correct?
Well, according to the Genius Act, payment stablecoin issuers cannot rehypothecate, that means lending. They cannot rehypothecate their reserves, right? So they are designed for the assets to always be there, right? When users go to redeem their stablecoins. If they were to rehypothecate, then you could end up with a situation where users go to redeem their stablecoins and somebody comes up short, right?
Right.
So, yeah, payment stablecoin issuers cannot meet those lending needs, right?
And this really is new territory. There's no other geography that has a stablecoin ecosystem, is there? This is pretty new. Not that they don't exist, but to this degree, everyone's interested in it. It's the exciting, shiny thing now. I saw a chart again at that clearinghouse event where the use of stablecoins is going just through the roof. But it's interesting. Do you guys want to talk about what stablecoins could be used for and maybe what they are being used for? Do you have knowledge on that?
Yeah, I could take a crack at it. Maybe we could start with the global regulatory framework. I think it is generous to say that it is extremely patchy. These are new assets, new technologies. So when you look at the rest of the world, most of the rest of the world, with the exclusion of some of the more advanced economies, are really struggling. And a lot of them have not even attempted to try to come up with a regulatory framework to control crypto asset activity within their borders. But we do have some activity from the advanced economy. So Europe, they've advanced a pretty robust regulatory framework so far. We're seeing similar efforts in Japan, Singapore, so on and so forth. But everyone was really looking to the US. And they were looking to the US because most stablecoins in existence reference the US dollar. Why did they reference the US dollar? Because the US dollar is king, right? We are the world's reserve currency. So again, of the approximately 300 billion worth of stablecoins in circulation, approximately 277 billion reference the dollar, right? So basically all stablecoins in existence, almost all of them, are dollar referenced. So there was a lot of anticipation from the rest of the world to see the US do something. So now that we have the Genius Act, right now, the baton is being passed to the regulators to flesh this out.
And do you know, so the chart said it's rising right now. It was my assumption that stable coins today are used to buy other, not stable coins, but maybe crypto assets. That's a whole different podcast.
Well, that is the primary use case right now, right? That was why stablecoins were created in the first place. You needed some sort of asset to maintain a stable value in an otherwise highly volatile ecosystem, right? I mean, I think your viewers are probably at least casually familiar with the price of Bitcoin, right? You can turn on CNBC at any point of the day and you'll see its price constantly fluctuating. It's constantly fluctuating because there's nothing behind it, right? Bitcoin, like so many other crypto assets, the value is just whatever the market thinks it should be. Maybe one day it's 100,000, maybe the next day it's 90,000. But a stable coin, at its most basic, right? It is supposed to be one token equals $1, right? Because there should be something backing it. And when you go to redeem that token, you should be able to get those reserve assets. But policymakers have been so interested in stablecoins, right? Because they are the nexus between all the volatility of the crypto ecosystem and the banking system, right? Because they have those connections by holding cash deposits, by holding treasuries. So, in a worst case scenario, if something goes wrong with a stablecoin or the whole stablecoin ecosystem, then cracks could spread to the broader crypto ecosystem. And those cracks in turn could spill over into the banking system. So that's why this particular asset, maybe more so than any other in the crypto asset ecosystem, has attracted so much attention, not just domestically, but worldwide.
Yeah, and if I could just talk to, the potential for disintermediation here. Stablecoins, like Brian said, were created really to facilitate transactions in other cryptocurrencies, but that's not all they could potentially be used for. So I think if they remain confined to that relatively narrow use case, then there's not really a big threat to a bunch of deposits leaving the system to go to that. I think the threat is, if adoption becomes much more mainstream, for that to happen, they have to find other use cases like, cross-border payments or even like domestic payments, right? I mean, if they can move money in a way that's somehow cheaper or more convenient than the traditional payment rails or, credit card networks, then there's now potential for a much broader kind of base of adoption. And I think if that's the scenario we go to, that's where the effects of disintermediation and deposit outflow, they get much worse. And I think that's what makes the stablecoin concerning to us is, Bitcoin, because of its volatility, is not so useful as a payments instrument, I think, is what's been discovered. But, something like a stablecoin might have a more mainstream use case there.
So I'm going to summarize a little, then I'm going to move a little bit on. So generally, talking about fintech entries into the banking world, it's objectively unfair from the amount of scrutiny a financial institution faces versus the amount of scrutiny of fintech faces. Just, if we had someone on the other side on this call, I think it would still be objectively just unfair. Stablecoin, from a stablecoin perspective, the use case of international transfers is like, yeah, easy. I struggle in thinking about walking into a McDonald's and buying a burger with my stablecoin. I struggle. There are so many other options. What would benefit using a stablecoin? I'd love you to talk about your response letter for this particular thing. Maybe you want to talk about just the general position you have for any of these charters. I just read the letter again. I don't have it in front of me. Do you want to outline just a couple of those points?
Yeah, so I think the first big point is we think that the way the OCC has gone about reintroducing the statute is it's not procedurally correct, right? For there to be a major substantive policy change to say, these banks that were once traditional trust banks, now they're going to be the gateway for cryptocurrency into the banking system. That's a major policy change that we think should require an act of Congress or at the very least a formal rulemaking. So that's one of our arguments, is really to try to get the OCC at a minimum to define through a rulemaking what the powers of this charter are. And I think some of the things that we would like to see addressed there, and we make these arguments in our objections to each of these charters as well, but we would like to see clearer guidelines for how does the OCC supervise these institutions, right? How do they make sure they're holding the reserves that they say they're holding against their customers', deposits? How do, if one of these institutions fails, what are the OCC's procedures for resolving it, right? Traditionally, if a bank fails, it goes to the FDIC. In this case, because it's not FDIC insured, the OCC would have to be the receiver. Is it equipped to do that? I think that's something that we would like to see a rulemaking address. So, we also talk about some of the, the blurring of the lines of, bank activities and what, you're allowing non-banks to do. Are you allowing them to offer something that to a customer looks like a traditional demand deposit, can be accessed with a debit card, but doesn't have those same protections of FDIC insurance? And, does the customer know that when they're getting into this? So I think those are some of the objections we've made in a lot of our comment letters. We've also talked about, as I mentioned earlier, the lack of Federal Reserve oversight at the holding company level. But I think for the most part, what we want to see here is, for a major change like this to happen, it really should require an act of Congress, and it shouldn't be done through an interpretive letter. We don't think that's the way to, have a major overhaul to what this charter can do.
Brian, anything?
No, I think Mickey really summed it up well. And I would underscore those concerns about resolution, right? We have to think about, the entities looking at this. I mean, these are very large, complex organizations, that could be issuing crypto assets that could circulate anywhere in the world, right? So if something goes wrong, it is going to be extremely complicated to get these things unwound properly. So it is definitely a very pressing concern for us.
Every time I hear this argument, because it's a common argument that fintechs don't face the same regulations as banks. Why isn't anyone, and sometimes I'm naive, so please, no chuckling. Why haven't we just decided to start regulating fintechs more? Anyone?
Well, I think it's look, the banking system was, the way the regulatory environment evolved is it evolved in layers. It evolved over the years, right? Each new layer of regulation was invented as a response to some previous failure or crisis. Mm-hmm. And I think, as those layers have added up, it's kind of natural for people to want to try to find ways around that, looking at less regulated charters. And the way I see it is, where we're at with cryptocurrency now is we're sort of in the Wild West, right? They're looking to do a lot of the same services that banks do, but unencumbered by all of those layers of regulation that have evolved over the years. I think, unfortunately, what will happen is, you will see failures in the space, just like we saw failures in the banking industry. And those failures, I think, will be what is the catalyst for layers of regulation in the cryptocurrency space. That's kind of how I see this evolving. And, a lot of the risks are the same. And it's just unfortunate that we have to kind of learn hard lessons over and over again. But even just what is the classic risk to a bank, right? A run on the bank. That risk is still present in the case of these cryptocurrency focused national trust banks. If you have a lot of depositors who put dollars in and get the stable coin out, suddenly change their mind and say, you know what, I don't want the stable coin, I want my dollars back. If you have a large volume of those redemption requests at once, it's the same problem a bank faces. That stablecoin issuer or that custodian of those reserves has to now liquidate a large volume of its reserves all at once. Now, again, in theory, that's supposed to be safe because, well, they're treasury securities, they're the safest asset you can get. But when you're talking about an institution that's potentially tens or hundreds of billions of dollars in scale, a large liquidation, even of a very safe asset, can cause a big dislocation in the price. And so now you're in a scenario where once that run happens, it's liquidating treasuries into a market where there may not be demand for those treasuries. So now it's not getting a dollar back for every dollar that it has in its reserve. And, the customer, we think, is unfortunately going to be left holding the bag there because they don't have the same protections they do in a bank deposit.
I think that's exactly right. But isn't there, no one ever talks about the other side of it. Isn't there a gas fee? Isn't there, if I make a transaction, there's a fee for that transaction. I mean, it's not free, right? And no one ever talks about I know when you, like, if I use a stable coin to buy an NFT of my cat, there's a fee for that. There's a gas fee. No one's talking about the fee that it's going to cost for that exchange, let alone the possibility that that dollar isn't worth a dollar. Yes?
Yeah, so I mean, you're right. Like every blockchain ecosystem, they have fees, right? Because every sort of activity in a blockchain ecosystem requires computing power. So you have to pay for it, whether you're doing like a straightforward, transaction like that, right? To buy an NFT, or you're deploying some sort of, complex smart contract to support a new decentralized finance application, right? Everything has a fee. But I would say like this is getting attention. I mean, it was only earlier this week that the OCC issued yet another interpretive letter, 1186, to permit banks to hold crypto assets in order to pay gas fees for permissible crypto-related activities, and also to test systems, right? So if a bank wanted to hold some crypto assets on their balance sheet to then test a new wallet system they wanted to deploy, per this OCC interpretive letter, that's okay.
That's really interesting because didn't we see earlier this year where a bunch of interpretive letters just disappeared because someone wrote another letter that said those don't count anymore? Yeah.
So under the Biden administration, there had been a series of statements from the prudential regulators that it limited banks' crypto-related activities. So with the new administration, all of those have been pretty much lifted. So in the wake, now we're starting to get additional statements clarifying additional activities.
Exactly right. Exactly right. Okay, so what is been the success rate of letters that say, we don't think this is a good idea in the past? Any other examples we can look at and say, the industry responded negatively to these folks getting a license? Charter?
So I think what I would liken this most closely to is our campaign we've had against industrial loan companies. So we've opposed commercial ownership of industrial loan companies, which is another kind of niche charter type. We, have filed letters in each of those applications, for Ford, General Motors, and so on. And also we've had Congress has introduced legislation to close the ILC loophole. It hasn't been enacted yet. But overall, I think so far that campaign has been pretty successful. We've delayed any new ILC approvals really throughout the Biden administration, throughout the first Trump administration. There have been a few financially owned ILCs, But from commercial companies like the automakers, we've managed to delay those applications and prevent them from getting approved. And the precedent there has been the failure of GMAC, which is, the most notable ILC failure. And it's kind of like, do we want to go down this road again? So that shows that these campaigns can be effective. At the very least, they make regulators, think about it and give them some pause. But I think, for the National Trust Bank charter, this administration is a pro-crypto administration. They want to be seen as a pro-crypto administration. I think that makes our job a little harder opposing these charters. But it does, it says, for anyone out there in the audience that's concerned about this, I would urge you to, get involved, write to your member of Congress, write to the OCC if you so choose. But those voices do matter, right? I mean, I think they're getting one side of the equation right now. Crypto, they have a big presence on Capitol Hill. They have a big media presence. That's the side lawmakers are hearing. They're hearing, oh, this is, it's decentralized. It's the future. It's great. They're not hearing some of the concerns I think that, community bankers have. And so I think that's, that's our job to amplify those. But I think it's the audience too. You can go out and make those concerns heard so that members of Congress and the regulators are getting the other side.
I think that's such a good point. I had a little story, and then I'm going to ask you if you have anything else to add at all and some closing. But little story yesterday, we get roll calls all the time. And yesterday someone called and said, oh, a member of ours wants to pay their loan payment with their Cash App. Another case of a non-bank in a banking field. So that belief that the average person may think, maybe they think that the stablecoin is the next Bitcoin, and all of a sudden they're putting all their money into the stablecoins because it's going to go up. I know it's going to go up. That education is so important. The understanding of what it really is has a lot of holes in it. People may not know what they're doing when someone says, "Oh yeah, you got to get stablecoin. You have to do it." It's interesting. With that, I'll any closing remarks?
I mean, Joe, I'll just kind of like build on like what you said. Like, education is really key here, right? I mean, from a consumer perspective, education is absolutely essential, right? We know that consumers are being hit with a lot of crypto scams right now, right? Crypto scams that are more commonly known as like pig butchering. That is the single largest financial crime in the U.S. So there is definitely an urgent need for consumers to get more education before they put their money into these assets. But there's also a really urgent need for bankers to be educated. Mm-hmm. These are very complex technologies that, while they might have like some similarities with the traditional payment systems that they're accustomed to, there's some pretty big differences. And it's really important now for bankers to start diving into these details because, as we've been talking about all throughout the show, the regulatory rulemaking is underway, right? So if you want your voice to be heard, if you want a regulatory framework that addresses the concerns of community banks, but also leaves paths open so banks can start to explore whether stablecoins or other crypto technologies have some benefits for them and their customers, right? It starts with education, and then it that has to lead to advocacy, right? So we very much are encouraging bankers get educated. ICBA is doing our part to make resources available to bankers, but I know organizations like yours also play a really key role in that as well.
So I'm doing a quick, a session this year on stablecoin, but can you talk a little bit? How would they? I mean, you do a lot of writing, don't you? How would I get a hold of some of your writing?
I mean, we can just send it to you.
No, as a listener.
So that's why an organization like ICBA is so important, right? It's our job to filter out a lot of the big developments, focus in on what is most important for community bankers. So, I know that a lot of the bankers probably don't read all the many, many pages that we write and with these comment letters, but it's our role to like distill it down and really give them short takeaways, because we realize, right, all community bankers, they have very busy day jobs, right? They're out there in their communities making loans, starting up new businesses, so on and so forth. So yeah, we've got a wealth of resources, and we are working to develop more because we recognize that this education gap, it's really critical that we fill it as quickly as possible.
Yeah, and I think I'll just chime in with a brief closing thought. I'll give credit where credit's due. The crypto industry, they've done a good job of telling the story, their story of the virtues of cryptocurrency. That's why they've had the successes they've had on Capitol Hill. And I think, our response to that needs to be telling our story, telling the story of, if there is a large amount of outflow of deposits into stablecoins, if this becomes a major part of the financial services industry, that's going to have adverse effects on communities that banks serve. It's going to translate to fewer loans, and it's going to translate to customers who are now protected by deposit insurance, but in the future they won't be. And so I think raising those concerns with policymakers and making sure that they get that side of the story, that's our role as an industry. And I think that's what we need to start doing more of, because again, it's ultimately the consumers that will be hurt when one of these institutions eventually fails. And we want to make sure the customers are as educated as possible to prevent that from happening. That would be my takeaway.
Thanks. Thank you both for joining me today. Please stay tuned and look at the episode. There'll be lots of links in the description. Thank you very much. Have a great day.
On behalf of Niche, your trusted resource in payments, and our guests, I'd like to thank everyone for tuning into the podcast. If you've enjoyed this episode and want to hear more about payments innovation and modernization, you can find the Wrestling Payments Podcast on the podcast page of niche.org or wherever you subscribe to podcasts. Just search for Wrestling Payments in your podcast app. Thanks for listening.